Hi everyone, this is Jimmy Allen, founder and CEO of Investalytix. Let's get into it. Peter Lynch once said, everyone has the brainpower to make money in stocks, but not everyone has the stomach for it. Now that line couldn't be more relevant right now. You know we are heading into the final stretch of what's already been an impressive year for the markets. And a lot of investors are asking the same thing. Can this momentum really last? From where I sit, the answer is yes, but with a little nuance. You see, the setup for the next 2 months looks constructive. We've got a healthy mixture of momentum, improving breadth, and a steady cooling in yields, basically all the right ingredients for a strong finish into the year. Now, historically, when markets post solid gains heading into November, they often keep climbing through December. Now, I'm not going to throw out, specific statistics, but history consistently shows that strength leads to more strength. Let's break it down. Now, here's what's interesting. Even with all that strength, sentiment still hasn't caught up. The AAII survey, which track retail investor outlook, has been averaging around negative 11.2, this year. Now, I did talk about this, last week video, just showing how the sentiment just turned even more, bearish. But if you look at the average, what I'm showing here in this table, it's negative 11.2. Now, that kind of reading you normally see during a bear market, not the rallies. So the mood out there is still cautious, and that's actually positive for the market. And let me tell you why. Because market rarely top when investors are still, skeptical. Right now, the trend remains intact. Leadership hasn't cracked. We have seen some pauses along the way, but the structure underneath looks solid. Let's go to the next slide. Let's talk big picture now. Here you see the S&P 500, and you see that price is riding that rising trend channel since April. Momentum remains healthy, as we can see that, right? Even after that late, October shakeout that we see. Now, we might get a short-term pullback based on, seasonality and based on this, the market is maybe, you can call it, overbought. But that's totally normal after such a strong run. But the underlying structure still bullish. And that's kind of what we see here. If you see that channel, we are going in this channel, we're going to the top end and then going down, going up and going down. And as you can see now, we have reached that top, end of the trend. And maybe for the next week or two, we're going to get some, consolidation, or maybe even go lower and maybe just go between that 20-day moving average, the blue line, and the green line, the 50-day moving average, hoping that 50-day moving average doesn't get violated at 66.40. If we can hold support right there and then push back up all the way to the top and end the year peacefully. That's kind of what we're shooting for here, based on what technically what the data is showing. And again, this is big picture, and the market strength this year has been driven mostly by technology. And no surprise there, right? But the rest of the market still hasn't fully joined in. And I'll talk about it later on. We need that rest of the market, to join in to keep this baby going up higher, right? Let's go to the next slide. Now, the equal weighted index continues to lag, which tell us participation remains narrow. That doesn't mean the rally is in trouble. I'm not saying that, right? It just means that it's still top heavy, carried by just a handful of mega cap. For this bull run to stay healthy and extend into the year end, we will want to see breadth really improve. Now, this chart compares the equal weight RSP to the standard index, S&P 500 SPX. You can see the ratios still sliding lower. It's hitting fresh lows, which means that large caps still carrying the load. Again, for a stronger, more sustainable advance, this line needs to flatten and eventually turn up higher to show rotation underneath, the surface. And just last week, it got even worse. If you can see that drop, it dropped way below that channel, that trend line. And it's trying to stabilize. Let's see if it's stabilized or it might go even further. But again, we're thinking in the next 2 weeks, it's probably going to be ugly. So this might even get worse. Or, it might get ugly for the large cap, right? Mega cap. And that's okay. And then maybe this rotation will happen and maybe that trend of this ratio will start going higher, right? We just have to, just have to watch it. Let's go to the next slide. Now, let's take a look here. Looks like small caps are showing some life. Again, that's good. Now, the Russell 2000 has been one of the better stories since April. After months of lagging, IWM broke out earlier this fall, and now it's consolidating above key moving averages. That's good sign. Buyers are holding up, the line instead of just, chasing it. If yield keep easing, small cap should stay, supported and could easily make another leg higher as we move into December. All right? I guess we shall see, right? Let's go to the next slide. Let's talk about yields. The 10-year Treasury has pulled back toward the 4% area, and I do believe this is a big psychological level for the market. You see, falling yield help valuation, especially for growth and small cap names, and they also take pressure off credit market. From a technical perspective, from a technical view, yields have broken below short-term support, lining up with a softer inflation backdrop. That have been, and I do believe that have been one of the main drivers behind this latest move higher in equities. It also worth noting that inflation have been easier and faster than what most people expected. The Fed knows it, even if they are not saying it. Whether they cut in December or not isn't really the point. What matters is the direction of the policy. We are moving from restrictive toward neutral, and that shift is generally bullish for risk assets. Eventually, the ultimate goal is easing, right? But it is definitely bullish for risk assets. Let's go to the next slide. Meanwhile, volatility has cooled off sharply after the October spike. Now, fear peaked right when headline looked the worst. A classic setup, guys, that tend to precede strength into November and December. Now, we have climbed that wall of worry all year, basically. Government shutdown chatter, trade tensions, regional bank fears. And yet, the market keeps pushing higher and higher. That's not weakness. Come on. That's actually resilience. Now, after such a strong October, a little chop in early November would definitely make sense. Just a short reset to digest all this gain, right? If the year's pattern hold, that could set up another push higher later in November and December. So here's the takeaway, guys. The trend still your friend. Momentum firm. Breadth is starting to improve. Yields are easing. Sentiment far from overheated. That mix usually support a positive finish. I am watching short-term pullback as opportunities, not warnings. Staying patient has been one of the most winning move all year, and it still looks like the right call to make as we close out 2025. If you found this helpful, give it a like and subscribe to the channel. It helps us reach out more data-driven investors like you. And head over to investalytix.com, create your free account. Thank you for watching.